Welcome everyone. Thank you for joining me. Originally, this presentation was done via a webinar. We didn't record it at that time, so I'm gonna record this and hopefully you guys can find some helpful information in here from the CARES Act and a little bit of the CQR Act. It's kind of morphed over time since early March, which seems like eons ago, so we're going through some of the final regulations and things that the IRS has cleared up as far as the CRDs and how to treat them. So originally we were accepting questions. So this slide is not applicable. However, if you do have any questions after this presentation, please feel free to email or give me a call. I'm happy to answer any questions. So these are the summary of topics that we're going to go through. Basically, the first topic is coronavirus-related distributions, or CRDs. We'll talk about the eligibility for them, the limits on them, the tax reporting, the benefits of taking them, when we put them back, you're allowed to put them back, recontribution or rollover, however the term is. There's a couple of different terms floating out there, and how these are reported. The second topic is going to be the enhanced participant loans, and we'll go through the eligibility for those and the limits on those, and also some calculations on the repayment when you suspend it. There's some examples and a safe harbor that the IRS has put out there to guide us so that we don't get into any trouble. Topic 3 is we're going to go through the required minimum distribution waiver, or RMD waiver, under the CARES Act. And then as the CQR Act, which was passed last year, which seems like eons ago, there's also some changes to the RMDs in that. And then we're just going to go through some miscellaneous provisions of the CQR Act. It's a comprehensive act, so we are hoping to have some more presentations on those. And if you have any specific topics that you like for us to cover, I'm happy to put together something tailored for your needs. So basically, we're going to go through, first and foremost, is a qualified individual and a non-qualified individual, and what is available to each. So, and we will go through the definition of what a qualified individual is on a later slide. So for qualified individuals that have been affected by the coronavirus or COVID, that is the distributions, the CRDs, which are available from January of this year to December 30th of this year, and that's not a typo. It is the 30th and not the 31st. Some of these dates don't coincide, so it's important to kind of delineate and pay attention to them. And it is available from eligible retirement plans, which we'll go through, IRAs, and certain DB plans after age 59 and a half. The other relief is participant loans, and what those are increased loan limits, and they are available from March 27th of 2020 to September 23rd of 2020. And they're also allow for the repayment of participant loans, a delay for repayments from March 27th of 2020 to December 31st of 2020. And the loans are only available from eligible retirement plans, no IRAs. And it's important with the loans that in order to receive the repayment delay, that the loans must have been current by March 27, 2020 and not in default. So basically, qualified individuals and non-qualified individuals, all individuals, the 2020 RMDs have been suspended for all IRAs and eligible retirement plans. And the eligible retirement plan is important as it does not include all retirement plans, which we'll go through in the next few slides. So now for the what is an eligible retirement plan for the CRDs and enhanced loans, and as usual, it depends. So it's available to qualified individuals only, which we'll go through the definition of that. And an eligible retirement plan for CRDs are what they call individual account plans, which generally are DC plans or defined contribution plan types. And that would be your profit sharing plans, 401ks, 403bs, and 457s. I know you guys don't really deal with the 457s. They're more for larger employers as well as 403Bs, but I just thought I'd put that in there. The CRDs are also available from IRAs and also certain defined benefit plans after attaining age 59 and a half. So most of this relief does not pertain to a lot of the defined benefit plans, only in certain limited circumstances. With regard to the enhanced loans, the eligible retirement plan for that would be, once again, the individual retirement plans, profit sharing 401k, 403, 457, and also DB plans if the plan allows for loans. Not all do, but some do. With regard to IRAs, the loans are not available from IRAs. IRAs are not allowed to hold participant loans, as well as some other types of investments. So with regard to these provisions, they are at the discretion of the employer, whether the employer would like to have these options in the plan. If the employer does want to have these provisions, they can what we call operate in good faith, and they don't have to formally have it written into their documents until 2022, which coincides with we have a next round of restatements for our DC plans, which you guys will hear about soon. We'll be sending out some information on that. Every 5 to 6 years, the IRS requires that we restate our documents to comply with the new tax laws, of the tax laws that have changed since the last time it was put on paper. So that's up and coming. So now we'll go through who is a qualified individual for both the CRDs and the enhanced loans. And, with regard to an employer, the only thing that is required, you don't have to do a whole bunch of investigation as an employer. The IRS has allowed for self-certification by the participant. And there are some certifications for the participants to sign. And, we recommend that it all be documented. So if it's ever looked at, especially 3-4 years from now, we're not going to remember, or I won't. I don't remember exactly what I've done 3 years ago on certain things. So it's important to have all of this documented so there's no question should it be looked at. So, basically the individual, their spouse, their dependent is diagnosed with COVID-19, or the individual spouse, or a member of the individual's household, and they define that as someone that is sharing the principal residence of the individual, experiences adverse financial consequences of either being quarantined, furloughed, laid off, having your work hours reduced due to COVID-19, or you can't work because you don't have childcare due to COVID-19, maybe the school's closed, things along those lines. Or a business is owned or operated by any of the above person is closed or the operating hours are reduced. Now, they did add this one recently where if an individual experiences a reduction in pay, not just hours, in pay, and that includes self-employed income due to COVID-19, or if you've had a job offer rescinded or a start date for a job delayed due to COVID-19, you would also be considered a qualified individual. So it's pretty expansive. And as once again, the only thing that is needed is self-certification by the participant. So now that we've got the background in that, we'll go to topic 1. So we'll go through CRDs to qualified individuals, and you'll see down there, please submit questions via private chat. That was originally for the webinar, so that's not applicable during this. But as I said, you can always either email me or call me, and I'm happy to answer any questions. So once again, who's eligible to receive a CRD? Well, it's available to QIs only, qualified individuals. It must be made from one or a combination of the following: eligible retirement plan, an IRA, or the DB plan after age 59 and a half. The dates, once again, are 1/1/20 through 12/30/20. And the limit is $100,000 per person, and that's an aggregate limit from all sources and not just per plan. And on the bottom here, so when we chatted a little bit about the loans, a deemed distribution of a loan in violation of Section 72P, so that would be a loan that you haven't made the payments in and it's considered in default if not paid by the due date or the grace period. And the The statutory grace period is the last day of the quarter following the quarter that it's due. So let's say, for example, I'm doing this in August. The last day of this, let's say the payment is due today, the quarter ends September 30th. My final payment due date would be by December 31st of this year. And that is in absence of the CRD. That's just what they call the cure period or the default period for the loan. So you cannot get the favorable tax treatment for a defaulted loan in a plan. I'm just going to go through a little bit about the Roth IRA. So I've gotten this question of, can you take a CRD from a Roth IRA or a Roth 401k by a qualified individual? And you can take it. However, if you do not meet the Roth criteria, which is the normal 59 and a half, death, five-year holding period, it will not qualify for favorable tax rules. So you would owe earnings on the income in that Roth IRA if it has not been taken by this date. So, and the taxation will be under the more favorable rules for the CRD. So that means that you can put it back within 3 years, which will go through the favorable tax treatment, but you are eligible to have the favorable tax treatment. You just have to pay tax on the earnings of the Roth IRA if taken prior to that period. After that period, then, all's good. So the features or benefits of a CRD, it's not subject to the 10% premature distribution penalty. So that is for individuals that are under 59 and a half. If you take a distribution, there's a 10% distribution penalty that is waived. You can spread the tax ratably either over 3 years or you can pay it all in 2020. You can also recontribute or re-roll over or roll over. You may see a few different terms on that within 3 years from date of receipt. And if you've taken several distributions made in 2020, all have to be treated the same way. So either you're going to pay them all tax in 2020 or 3-year ratably. Now, when you recontribute, it's 3 years from the date of the receipt of the funds. And it hasn't, there are no FAQs in the regulations with regard to, let's say, for example, you take 3 CRDs. It's our opinion and a common opinion that it's 3 years from the date of receipt of each of those. So you would have 3 separate dates to pay that back. We haven't seen clarification in that, but that's the way most are interpreting that regulation. So the amount recontributed cannot exceed the amount of the CRD. You can't increase it for earnings. And with regard to the withholding, a 10% voluntary withholding will apply rather than the 20% mandatory withholding on distributions from retirement plans. So I thought this is an interesting fact. I'm not sure if you guys will, but let's say, for example, the employer does not amend the plan for a CRD. However, the participant, there are in-service distributions from the plan, and the participant is able to get their money. That's the first thing. To be able to get the money out of the plan, you need a distributable event. The participant can consider it a CRD whether or not the plan had adopted those provisions. So it really is up to the participant, assuming they can get their money from the plan under another form of distributable event other than a CRD. So now, how is the CRD reported by the payor or the plan or the IRA? So the guidance says that it's reported on 1099-R. If the distribution is a CRD and no other code applies, you're going to use code 2. Early distribution exception applies in box 7 of 1099-R. And even if the individual recontributes the distribution to the same plan in the same year, 1099-R reporting is required. So now here's where we're going to kind of get into the weeds a little bit, and we'll go through some examples. I thought they may be helpful, as I would imagine your clients are going to you for reporting of these and how these are treated. So qualified individuals are going to use Form 8915E to determine the following. And this really mirrors the Katrina regs. 8915 is a form that's been around for a while. It was D. Now it's E. So they just kind of update it for whatever disaster is applicable, and a lot of these regs will follow the old Katrina regs if you look at them and you compare them. So the 8915 is going to determine whether the qualified individual is going to opt out of the 3-year ratable taxation, or if they're going to pay it in 2020. And it also is used to report any recontribution made during the year. Once again, if multiple distributions are taken, all must be treated the same tax-wise, and the method cannot be changed after filing the 2020 return. The recontribution must be made, once again, 3 years from date of receipt of the CRD. Now, the Form 8915E is forthcoming from the IRS. We're anticipating it's similar to the 8915D. That was the form I looked at when I put this together. And once again, it's required even if the individual, similar to the 1099R, even if the individual recontributes the distribution to the same plan in the same year, the 8915E is still required. So it seems as if there's a CRD, an 8915E is going to be required for 2020 in any case. So the selection, once again, is being made on the 8915E. You're either going to A, claim the CRD as income for 2020, assuming they don't recontribute to any plan. They're going to opt out of the 3-year rule on the 8915E, and it's taxable in 2020. Or the qualified individual is going to accept the 3-year ratable taxation, and then 1/3 is included in gross income for 2020, 2021, and 2022. And it's a ratable, it's ratably for over those 3 years. And we'll go through some examples. So once again, under both options, you have up to 3 years from the date of the distribution to recontribute. So, if you claim it all as taxable income in 2020, you have until 2022 to put it back. And amended returns may be required depending on the circumstances, and we'll go through some examples of that as well. So now this one's pretty straightforward. This is the first example. So let's say the participant opts out of the 3-year rule, and they want to claim taxation of the CRD in 2020, and they recontribute the full CRD before the due date of the 2020 tax return. It's important about the due date of the tax return, as you'll see in some of these examples. So in this example, you have taxpayer A. They received a $45,000 distribution on November 1st of 2020. They received no other CRDs in 2020. On March 31st of 2021, the taxpayer recontributes the $45,000 to an IRA. So they're putting this back in 2021. This would be before they file their tax returns. So they're going to opt out of the 3-year ratable exclusion on the 8915, and they're going to report the recontribution on the 8915E as well. The taxpayer A files the 2020 tax return on April 10th. So the result in this case, for taxpayer A, no portion of the CRD is includable as income for the 2020 tax year. And it's the same result for the extended due dates on the tax return. So this one's pretty straightforward. The next example is where you're going to opt out of the 3-year, meaning you're going to pay the tax in 2020 or that first lump sum, but you're going to put it back after the due date of your 2020 tax return. So once again, same data. The participant takes qualified individual takes $45,000 on November 1st, no other CRDs. They file their tax return now on April 10th of 2021, and they elect out of the 3-year ratable on the 8915E. So they're going to pay tax on that for 2020. And then on April 30th of 2021, they're going to recontribute the $45,000 to an IRA. So now we're within the 2020 tax return. So what they're going to need to do in this case is file an amended return for 2020, and they're going to report the recontribution on the 8915E. So this is going to be a popular form over the next 3 years for the 8915E. So once again, for taxpayer A, on the bottom, the result, right? It's includable as income for the 2020 tax year. The amended return is going to recoup the 2020 taxes paid on the $45,000 CRD. This is also, pretty straightforward as well. So now example 3, we're going to use the 3-year ratable without recontribution, and this one's also pretty straightforward. So in this case, we're going to take a $75,000 distribution. Again, November 1st, no other CRDs. The taxpayer files their 2020 tax return and is electing to use the 3-year ratable on 8915E, and they're not recontributing. So in this case, they would have to claim $25,000 income in 2020, $25,000 in 2021, and $25,000 in 2022. So now example 4, this is where we kind of get into the weeds a little bit. We have a couple of scenarios in here. So basically in all scenarios, they're going to elect the 3-year ratable, and they're going to, at some point in time, put this money back, right? So in scenario 1, the individual is going to recontribute less than the amount that is ratably taxable in that respective year. Scenario 2, they're going to recontribute exactly the amount that's ratably taxable in that respective year. And then in scenario 3, the individual is going to recontribute more than the amount that is ratably taxable in that respective year. So now example 4, scenario 1, the taxpayer is going to use the 3-year ratable, and they're going to recontribute less than the amount includable in income for that year. So in this scenario, or in these examples, we're going to use $90,000. So the participant is going to elect the 3-year with the 2020 tax return, so they're going to claim $30,000 in year 1, $30,000 in year 2, and $30,000 in year 3. In 2021, the taxpayer is going to recontribute $10,000. So in this scenario, once again, they're electing it on the 8915A. In 2020, there's a $30,000 taxable and $30,000 in income for 2020. In 2021, they're just going to take that 30, reduce it by the $10,000 recontribution, so they're going to include $20,000 in income that year. And then for 2022, we're back to the same $30,000 includable in income for 2022. So now scenario 2, once again, they're utilizing the 3-year, and they're going to recontribute exactly that amount. And this one's also, once again, pretty straightforward if we use the theory on the prior slide. So once again, $90,000 they get. $30,000 each year for 3 years is taxable, and they're going to recontribute $30,000 in 2021. So once again, in 2020, it's $30,000 is includable in income. 2021, they have 0 includable in income. In 2022, they have $30,000 includable in income. Once again, pretty straightforward. Now, this is where it kind of gets a little dicey. So now, once again, they're utilizing the 3-year ratable, but what's going to happen in this case is they're going to recontribute more than the amount that's ratably includable in income for that year. And with this, there's 2 different options for this. So once again, taxpayer takes $90,000, elects the 3-year with $30,000, $30,000, $30,000. And in this scenario, they're going to recontribute $45,000 in 2021. So in this case, they have $30,000 includable in 2020. In 2021, they reduced the $30,000 by the 45, and now they have a $15,000 excess. And with this, there are 2 options available in this scenario. And I think maybe, it might be an opportunity to do some tax planning on your end for your clients, depending on, where their taxable income falls in this particular scenario. So option 1 is either A, you can carry that excess forward into 2022, in which case your taxable, the amount you need to include in taxable income for 2022 is $15,000, or you can file an amended return for 2021 reflecting the excess. So you would go back to your 2020 tax return, file an amended return, and reclassify that and recoup the taxes you paid, and then you're left with $30,000 in 2022. So that's pretty much the CRDs. Once again, if you have any questions, please feel free to reach out to me. And I guess now we're going to go on to topic 2. Once again, please pay no attention to the man behind the curtain. No, I mean, pay no attention to the bottom on that slide with regard to Rochelle Newer. So now we're going to go into the enhanced loan provisions. Must be made to a qualified individual. The loan limit is increased to $100,000 or 100% of the vested account balance, the lesser of. It's available to qualified individuals only, once again, from eligible retirement plans, not from IRAs. And it is only available until September 22nd of this year. So that's an important date to pay attention to if you have any clients that may want to take advantage of this. And it must be reduced by current outstanding loans. So if you have a $30,000 loan outstanding, and you have a $100,000 account balance, you can only take $70,000. The CARES Act also delayed the payment on existing loans. So any payments made from March 27th until December 31st of 2020 may be suspended. And once again, the loan must be current and not in default as of March 27th of 2020. Repayments must begin January 1st of 2020. Interest is going to accrue on the outstanding loan balance during the suspension period. And the loan is going to be re-amortized based on the due date of the loan, and it's extended from 1 year from the original date of maturity. So for me, that was like, wait, what? The loan is extended for 1 year, but repayments start 1/1/21. Like, how do we do that? Last time I checked, 1 year from March 27th is 3/27/21, not 1/1/21. So we're going to go through some examples of that and how those things are how those are treated. So thankfully, the Department of Treasury and the IRS in Notice 2020-50, they provide a safe harbor for the calculation as well as an example, which is really helpful. And then they also realize that it's very complex to administer, and there may be other ways to do that, which is validation from the IRS, I always like to hear that. And a bonus, they gave us an example of one of those more complex ways to do it. So with regard to the safe harbor for the repayment, so let's say, for example, we'll go through this example. On April 1st of 2020, and this is from the regulations. So you have, on April 1st of 2020, you have a non-qualified individual, right? They have an account balance of $40,000 and they take $20,000. This is just a regular loan, right? They're not a qualified individual, half of their vested account balance. They're going to repay in monthly installments over 5 years, $368 per month, and it's going to be made through payroll withholding, and the maturity date is March 31st of 2025. So the participants making these payments for 3 months through June 30th, and then, bam, they become a qualified individual, which they self-certify to their employer. So what the employer does, they've adopted the provisions for CARES Act. So basically, they suspend the repayments from July 1st of 2020 through December 31st of 2020. They're suspended for the qualified individual. On January 1st, repayments of $343.27 resume. And this is how we get to that number. So they don't go through the calculations of $19,477, how we get to that, but it's basically the balance with accrued interest to January 31st. So at the time that the payment stopped, plus accrued interest until 1/1/21, the balance of the loan is $19,477. The loan is then amortized from 1/1/21 to 3/31/26, which, if you look above, the original maturity date was March 31st of 25. So we add a year to the maturity date and we re-amortize the balance of the loan over that payment. So that's pretty straightforward, and I think it's a pretty good safe harbor that they came out with to kind of navigate something that's really, really complex. Now, this was their example for the more complex method. I'd opt for the safe harbor method, but if it's advantageous for the client, perhaps, at least we have this in our pocket. So assume your loan say it was a loan that was taken before COVID, before the CARES Act, and it had a maturity date of July 1st of 2024. The suspension period, this person is a qualified individual. Right on April 1st, they self-certify, right? So the suspension period is going to start April 1st of 2020, and it's going to last through 1/1/21. So each payment that becomes due during the suspension period is delayed to April 1st. And it just kind of rolls forward a little bit. For me, it sounds a bit more complex, but it just kind of rolls forward. So the original scheduled payments of the original loan are made from 1/1/21 to 3/31/2021 with no change. And then on 4/1/21, the outstanding loan balance on 4/1/21, including the delayed payments with interest that were from 4/1 to 12/31, are added to that, and interest is accrued on each payment until 4/1/21. So you'll have, what is that, 7 calculations to do with regard to that to amortize it up to 4/1/21. And then it's re-amortized over a period that is up until July 1st of 2025, which is 1 year past the extended due date of the loan. Okay, so now we're going to go on to topic 3, and we're going to go through the minimum RMD distribution waiver, and this is pretty straightforward. There's a couple of small little tidbits that you might like to see, so I'll just go through that briefly. So with regard to the RMDs, it applies to all individuals, qualified and not. They're all RMDs due to be taken in 2020 are suspended for all individuals except defined benefit plans. So I know in some cases we have defined benefit plans with a profit sharing wrap to maximize the contribution. And I don't believe if you have any older individuals, so you would be required to continue to take the RMD from the DB plan, but the profit sharing plan or 401k plan would be suspended. And also the suspension includes the stretch and the beneficiary IRAs as well. So for those individuals that, the participant has passed and the beneficiary is receiving payments, those have been suspended. And then also those whose 5-year rule is expiring. So there's not many cases that I have like this, but, just so you know, so if someone dies before their required beginning date and they're leaving it to someone other than their spouse, if they don't take that by December 31st in annuity form, by December 31st following the date of death, the entire account balance must be distributed within 5 years of date of death. So for those individuals whose 5-year rule is expiring in 2020, they will have it extended 1 more year into 2021. And then also those who were a little late to the game, they delayed their first-time RMDs in 2019 RMD into 2020. They can suspend both 19 and 2020. If they've already taken their 2019 in 19 for their first time, unfortunately, that wouldn't apply. And then those who may have already taken the RMD, this is recent in the regs, they extended this due date. It was by, I think, July 15th, that, let's say, for example, you took your RMD in January, you have until August 31st of 2020 to return that back to the plan. So that's coming up in a few days. So if you have any people in that situation and they don't want to take that RMD, if it's not from a DB plan, they may put it back before August 31st. And then for DB plans, this is basically the only relief for anybody whose RMD was due 4/1/20. The deadline for your first RMD was extended to July 15th of 2020. And you also have to take the 2020 RMD. So now we're going to go to topic 4, the CQR Act and the age 72 RMDs. We have two two issues with regard to RMDs for 2020 that we're kind of navigating this year. The Secure Act was passed in 2019 and it's effective in 2020. So basically, what happened with the Secure Act, the required beginning date is age 72 rather than 70 and a half. Now, if you've already started taking your RMDs under age 70 and a half, it doesn't mean you can stop until you're 72. You have to continue. So this is only effective for those turning 70 and a half after after December 31st of 2019. So basically anybody born after June 30th of 2014, and it applies to all plan types. So if your birthday is June 30th of 49, you turn 70 and a half in 2019, right? Then your first RMD is 4/1/2020, and because of CARES Act, if you waited to take it to 2020, it's waived, right? So that's kind of the CARES Act spin in the Secure Act. And then if your birthday is on or after July 1st of 1949, you would turn 72 in 2021, and your first RMD would be 4/1/22. So once again, per the prior slide, if if CARES Act waives the 2019 for those who turned 70 and a half in 2019 and waited until 2020 until taking their 2019 RMD. This was covered on that prior slide. So if you have any question with regard to that caveat, just refer back to the prior slide for a little bit more detail on that one. And then for the Secure Act, also eliminated the stretch IRAs. So the pre-Secure Act allowed non-spousal beneficiaries to receive distributions over their life expectancy. So, let's say, for example, a participant dies at, 70 years old. Before the RMD. Let's say they die at 70 years old and they leave it to their child that's 20 years old, right? As long as that money is put into a stretch IRA by December 31st following the date of death, that participant or that beneficiary can spread that IRA over the expectancy of a 20-year-old, basically, over their life. So we'll just 21-year-old grandson, let's say you're 21, you can take it over 62.1 years. So after the Secure Act, the distributions to most non-spousal beneficiaries limited to 10 years. So in this case, he's not 21, he would be 60. If the person died when they're 70, if the participant died when they're 70, you would have to take that over the life expectancy of a 60-year-old for a non-spousal beneficiary. Spousal beneficiaries, that the rules haven't changed on that. You can still, the spouse can roll that over to their own IRA and take that according to their own RMDs. And the Secure Act in the Section 199A deduction, we're going to save that. That's just too extensive for this at this time. And basically, thank you so much. I'm glad you came. Thank you so much for your time. We wish you and your families much health in this new normal abnormal. And, as you can see on this slide, I've partnered up with my certifying actuary who I've had a relationship for 30 years, and we're combining efforts to provide more comprehensive services to our clients and to help WIA grow and do all sorts of things like that. So he was live on this original one, Ron Stair, and hopefully we can do another one for you live, or perhaps I can remember to record the original one, which I totally forgot to do, and he'll be on that as well, not live, but taped. So I hope you enjoyed this. Once again, any questions, happy to answer, myself, my staff, and thanks so much for your time. Take care.